Imagine you're standing in a battlefield, not with a rifle, but with a brokerage app open. On one side, tanks are rolling. On the other, the S&P 500 is ticking upward. Seems absurd, right? But here's the paradox. While missiles fly, economies stall, and lives are shattered, Wall Street doesn't always flinch. In fact, sometimes it climbs. So the question is simple, but the answer isn't. When war erupts, who wins? The battlefield or the boardroom? Let's strip away the noise and propaganda and look at this through the lens of history, strategy, and cold, hard numbers. This isn't just about bullets and bombs, it's about bonds and behavior. The psychology of fear versus the logic of finance. Sun Tzu versus Warren Buffett. Because while governments wage war for power, investors wage their own battles, fighting for safety, returns, and clarity in the fog of geopolitical chaos. So buckle up. This is not your typical finance video. We're diving deep into one of the most misunderstood dynamics in economic history. War versus market. Which one truly wins? Shock and shrug. When war barely moves the market. Let's rewind to a morning frozen in American memory. December 8th, 1941, the day after Pearl Harbor. You'd think the market would have collapsed in terror. It dropped, just 4%. Fast forward to 9/11, the most devastating attack on U.S. soil in modern history. The market reopened a week later and fell 5%. Why didn't panic turn into a full-blown collapse? Because the market doesn't react like a person. It reacts like a machine built on earnings, expectations, and consumer behavior. Wars stir emotions, yes, but unless the war disrupts commerce at scale, Wall Street tends to shrug. A 1989 study by Cutler, Paterba, and Summers confirmed this. They showed that most major market swings, like Black Monday in 1987, weren't caused by geopolitical shocks. Only 9% of big U.S. market moves between 1900 and 2020 were linked to military action. Why? Because markets are forward-looking. They price in risk, adapt quickly, and sometimes they just don't care. As cruel as it sounds, if war doesn't hit the economy's core, jobs, consumption, production, it often becomes background noise. Markets don't cry. They calculate. Total collapse when war becomes a financial abyss. But let's not get too comfortable. Sometimes war doesn't just rattle nerves, it obliterates economies. Think Germany after World War II. Once a powerhouse, its markets lay in ruins. Or the Confederate States after the U.S. Civil War. Investors holding Southern bonds got wiped out. No amount of optimism can save you when the very structure of a nation collapses. That's the thing. Markets may shrug off bombs in the distance, but if those bombs level banks, factories, or infrastructure, game over. Niall Ferguson put it best. Even if a country wins the war, its economy may still lose. The UK won both world wars, but British bonds tanked. Investors suffered for decades. War demanded massive government borrowing, and post-war austerity crushed returns. And let's not forget Russia in the 1990s. After the Cold War, the empire crumbled. Investors in Soviet-era bonds left with worthless paper. The takeaway? War doesn't guarantee destruction of markets. But when war destroys governments, industries, or national identities, investors pay the price. So while Wall Street may initially shrug, if Main Street burns to the ground, the market will eventually feel the heat. The illusion of opportunity. Buy on cannons doesn't always work. Buy on the sound of cannons, sell on the sound of trumpets. That old Rothschild quote gets tossed around like confetti every time a crisis erupts. But let's be real, it's more poetry than portfolio advice. Yes, fear can create opportunity, but does war consistently create undervalued markets? Not really. A 2010 study by Berkman, Jacobson, and Lee created a crisis index. They found that during major global crises, U.S. stock prices may look cheap, but they rarely outperform afterward. Why? Because fear isn't just skin deep. It seeps into corporate earnings, consumer behavior, and government spending. During the Gulf War in 1990, oil prices spiked. The Fed was hiking rates, and boom, a minor recession. Buying then? Not the worst decision, but it wasn't the golden ticket either. Compare that to 1942 when the US turned the tide at Midway. The market soared not just from hope, but because the industrial war machine was at full throttle. Factories were running 24/7. Jobs were booming, so yes, war can sometimes spark market rallies. But it's not the war, it's the surrounding economic environment that matters. Is the country already in a recession? Is consumer confidence broken? Is oil spiking or stabilizing? The cannons might be loud, but don't mistake noise for opportunity. Context is king. Same war, different impact. Two wars, two economies, two completely different market reactions. 1941, the US gets dragged into World War II. Stocks dip. But by 1942, as the tide turned at Midway, markets began to rally. Why? Because despite the chaos, the American economy was expanding, producing planes, tanks, and jobs. War-stimulated growth. Now rewind to 2001. 9/11 strikes. But this time, America was already limping. The dot-com bubble had burst. Corporate earnings were in retreat. The attack wasn't the start of pain. It was the accelerant. The result? A deeper recession. Stocks fell another 17%. Same kind of national trauma. Totally different economic backdrops. Ross Mayfield, an investment strategist, once said, "War only matters if it hits the US consumer." Because the American economy runs on spending. If people in Iowa or Texas stop going to restaurants, movies, and Target, that's when markets spiral. That's why wars abroad, unless they spike oil or shut down trade, often leave US markets largely unaffected. But wars at home? Or conflicts that send oil over $150 a barrel? That's a whole different beast. Always ask, what's the consumer feeling? What's the Fed doing? What shape is the job market in? Because context, not conflict, determines impact. Safe havens and volatility. Where the money hides, when tanks roll in, money rolls out, to safety. During every modern conflict, one trend holds. Investors run toward US treasuries, gold, and the dollar. They seek shelter, not risk. That's why, strangely, markets often rise days after war breaks out. It's not optimism, it's rebalancing. Treasuries spike, yields drop, and with lower yields, equities sometimes catch a tailwind. It happened after Russia invaded Ukraine. Despite the chaos, markets bounced. Why? Investors were moving money to the US, to bonds, and away from emerging markets. It happened again after the latest conflict in the Middle East. Oil popped, but stocks also rose. Why? Because the bond market was pricing in lower yields, which in turn lifted equities. But volatility still rules the day. Commodities, especially oil, are the wild cards. Wars in oil-rich regions send prices surging, which impacts inflation, corporate margins, and consumer wallets. So while investors may initially flee to safety, any prolonged war that chokes oil supply or disrupts trade routes will eventually punish stocks, especially in sectors like transportation, manufacturing, and consumer goods. War doesn't destroy markets directly, but it bends the rules of behavior. It reshuffles capital. It triggers fear, and fear always has a price. Timing versus tempo. War is sudden. Markets are rhythmic. War erupts like a lightning strike. Markets move like the tide. The nature of war is abrupt. It's an event, a moment in time, a missile strike, a declaration, an invasion. These are discrete, sudden happenings. The damage, both human and structural, is often immediate and irreversible. Markets, on the other hand, operate in rhythm. They absorb information, adjust expectations, and evolve. While they might react instantly to news of war, that reaction is often just a blip in a much longer pattern. Markets don't operate on emotions. They operate on cycles: bull, bear, recovery, expansion. This creates a fundamental mismatch in tempo. During a conflict, nations sprint. They draft emergency budgets, they mobilize troops, they print money. Investors, meanwhile, are running a marathon. They think in quarters, years, decades. They're not just trying to survive, they're trying to compound. This is why short-term panic is often the worst investment strategy. It's like throwing away your umbrella because you saw a dark cloud. The war may start with thunder, but the market will ask, will this rain last? In investing, timing the cannon shot rarely works, but staying aligned with the long-term tempo of economic resilience, that's where the real power lies. Destruction versus innovation. War destroys, markets rebuild. War tears down, markets build up. It's as simple and as brutal as that. War, by its very nature, is designed to destroy lives, infrastructure, governments, supply chains, trust. It sets back human progress by years, sometimes decades. Roads crumble, schools close, inflation surges, and uncertainty becomes the dominant currency. But here's the market's superpower. It doesn't just survive destruction. It often finds a way to innovate because of it. During World War II, radar, synthetic rubber, and even computers saw rapid development. The Cold War pushed forward aerospace and nuclear energy. In the 21st century, military-driven cyber investments have spilled into global cybersecurity sectors. The darker the conflict, the more desperate the solutions, and those solutions often feed future growth. This is where the market's engine revs differently. It sees wreckage and asks, what's the next version of this? What can be built from the ashes? Post-war periods historically have often sparked some of the most explosive economic booms. Think of Germany and Japan in the 1950s, or South Korea after the Korean War. Once the destruction ends, the rebuild begins, and markets love a comeback story. So yes, war destroys, but the market? It learns, adapts, and reinvents. One breaks the world, the other finds ways to fix it. Lessons from the art of war. Sun Tzu, the ancient strategist, wasn't thinking about the Nasdaq, but his teachings translate remarkably well. Do not fight unless you are determined to win. Protect your assets. The overly cautious can be captured. Illusion creates confusion. Investing during wartime is all of that and more. You must defend your financial fortress. Don't attack a tank with a pea shooter. Meaning? Don't throw cash at risky bets just because headlines say crisis. That's reckless, not strategic. Use the fog of war to sharpen, not shake, your focus. Don't assume calm means safety or chaos means opportunity. Position yourself where others can't hurt you. Diversification, strong cash flows, defensive sectors, and above all, never fight for profits without a plan. Because the market is its own battlefield, and every investor is a soldier. So, war versus market. Which one wins? The truth is, neither, and both. War wins when it reshapes economies, crushes currencies, and breaks nations. The market wins when it adapts, recalibrates, and moves forward despite it all. In the short term, war rattles. In the long term, the market absorbs. But you win by not reacting emotionally. You win by understanding that investing is not about reacting to cannons. It's about marching toward your goals with clarity and courage. Markets have survived Pearl Harbor, 9/11, Iraq, Ukraine, pandemics, recessions, and everything in between. They've bent, but not broken. So next time headlines scream of war, pause. Ask, is this noise or a true signal? Is the economy still functioning? Is the consumer still spending? Is your portfolio armored for the storm? Because in this battle of chaos versus capital, it's not about choosing sides. It's about staying strong, staying smart, and staying invested. If this helped you see war and markets from a new angle, hit that like button. Drop your thoughts in the comments. How do you stay calm when the world feels chaotic? And don't forget to subscribe and ring the bell. We've got more human-centered finance stories coming your way. Because money, like war, is too important to leave to chance.